Welcome to the series Should I Invest or Not? In this stock analysis, we'll examine various aspects of Walt Disney's financial performance, including its revenue growth, profitability, and valuation. Make sure you stick to the end of the video so you get all the knowledge you need before you decide if you want to invest in Walt Disney or not. It can cost you a fortune if you don't know all the information about a potential investment. Walt Disney is a multinational mass media and entertainment conglomerate that's headquartered in Burbank, California. The company was founded in 1923 by brothers Walt and Roy Disney and has grown to become one of the largest media companies in the world. Oh, and before we give you the full review, remember to hit the subscribe button to make sure you get our daily stock analysis. And we'll really appreciate it if you also hit the like or dislike button as well. So now, let's get back to the analysis. Walt Disney's revenue growth has been relatively consistent over the past few years. In 2020, the company reported revenue of $65.4 billion, a decrease of 6% compared to the previous year. This decline can largely be attributed to the impact of the COVID-19 pandemic, which led to the closure of many of the company's parks and resorts, as well as the cancellation of many movie releases. However, it's worth noting that Walt Disney's revenue growth has been strong in other areas of its business. The company's direct-to-consumer streaming service, Disney Plus, has been a major success since its launch in 2019. In the fourth quarter of 2020, Disney Plus had over 73 million subscribers, and the company expects this number to grow to between 230 million and 260 million by 2024. This growth in Disney Plus subscribers has helped to offset some of the declines in other areas of the company's business. Walt Disney has historically been a profitable company, with strong margins and returns on investment. However, the COVID-19 pandemic has had a significant impact on the company's profitability over the past year. In 2020, the company reported a net loss of $2.8 billion, compared to a net income of $12.6 billion in 2019. This loss was largely driven by the closure of parks and resorts, as well as the decline in box office revenue. Despite this decline in profitability, there are some positive signs for Walt Disney's future. As mentioned earlier, the company's direct-to-consumer streaming service, Disney Plus, has been a major success and is expected to grow in the coming years. This should help offset some of the declines in other areas of the company's business and could lead to improved profitability in the long run. Walt Disney's valuation is an important consideration for investors. As of March 6, 2023, the company's stock price is $189.50 per share, giving it a market capitalization of approximately $342 billion. This valuation represents a significant premium to the broader market, with the S&P 500 trading at a price-to-earnings (PE) ratio of approximately 22, compared to Walt Disney's PE ratio of approximately 48. While Walt Disney's valuation is relatively high, it's worth noting that the company has historically traded at a premium to the broader market. This is due to the company's strong brand and intellectual property, as well as its diverse range of businesses. Additionally, as mentioned earlier, the growth potential of Disney Plus is significant and could justify a higher valuation in the long run. While Walt Disney has many positive aspects to its business, there are also several risks that investors should be aware of. One of the biggest risks facing the company is the impact of the COVID-19 pandemic. While the worst of the pandemic appears to be over, there's still a risk that a new variant of the virus could emerge, leading to renewed lockdowns and restrictions. This could have a significant impact on Walt Disney's parks and resorts business, as well as its movie and television production businesses. Another risk facing Walt Disney is the competitive landscape of the media and entertainment industry. The company faces competition from both traditional media companies, such as Comcast and Viacom-CBS, as well as newer digital players like Netflix and Amazon. This competition could put pressure on Walt Disney's pricing power and margins, particularly as consumers have more options to choose from when it comes to streaming content. Lastly, there's also a risk that Walt Disney's investments in its streaming business may not pay off as expected. While Disney Plus has been a major success so far, there's no guarantee that the company will be able to continue to grow its subscriber base at the same pace in the future. Additionally, the company is investing heavily in content production and marketing for its streaming service, which could put pressure on its profitability in the short term. Overall, Walt Disney is a company with many positive attributes, including strong brand recognition, a diverse range of businesses, and a successful streaming service in Disney Plus. However, the COVID-19 pandemic has had a significant impact on the company's financial performance over the past year, and there are also risks associated with competition in the media and entertainment industry, as well as the potential for investments in streaming to not pay off as expected. Investors considering investing in Walt Disney should carefully weigh the risks and rewards of the company's stock, and pay close attention to developments related to the pandemic and the competitive landscape of the industry. With that said, for investors who are willing to take on some risk, Walt Disney may be a compelling long-term investment opportunity, particularly given the growth potential of Disney+. We really hope you liked the video. If there's anything we can do better, please leave a comment and tell us. Otherwise, hit the like and subscribe button, and we'll see you in the next investing video. Have a great day.